In today's fast-paced world, everyone seems to be in pursuit of quick wins, especially when it comes to money. The allure of fast profits has made short-term investments increasingly popular. Cryptocurrencies, volatile stocks, and speculative ventures promise instant returns, creating an environment where people are constantly looking for the next big opportunity. However, while these short-term investments can seem enticing, they come with high risks and uncertainties that are often overlooked. But there's another side to investing, one that focuses on long-term growth and stability. This approach may not offer the instant gratification that many are searching for, but it has proven to be the path that leads to sustained wealth and financial security. By focusing on long-term investments, such as stocks in established companies, real estate, and mutual funds, you can build a robust financial future that doesn't rely on constant market fluctuations or the latest trends. In this video, we will dive deep into the world of long-term investing, exploring why it is a smarter choice for those who want to secure their financial future and avoid the roller coaster of short-term speculation. We will also highlight how time, often seen as an enemy in the world of high-speed trading, can actually be your greatest ally. By investing with a long-term mindset, you unlock the power of compound growth and wealth accumulation, ensuring that your money works for you over time. So, if you are between the ages of 30 and 45 and are looking for ways to build financial stability, this video is for you. Get ready to understand why long-term investments are the key to transforming your wealth-building strategy and achieving true financial freedom. While the idea of making quick money is undeniably appealing, it's essential to understand the risks that come with short-term investments. In recent years, we've seen a surge in the popularity of investments that promise immediate returns. Cryptocurrencies, day trading, and even options trading have all become buzzwords in the financial world, attracting individuals eager to make a fortune overnight. While these options can indeed yield substantial profits, they also come with immense volatility and uncertainty. The psychology behind short-term investing is driven by a desire for fast gratification. People are often drawn to the idea of making a quick profit, not considering the fact that these types of investments can just as easily result in significant losses. Take, for example, the boom and bust cycle of cryptocurrency markets. During a rally, it can feel like you're missing out if you're not participating. However, the volatility means that prices can drop just as quickly as they rise, leaving many investors with more losses than gains. Moreover, short-term investments often lack a solid foundation. Instead of being driven by company fundamentals or long-term growth potential, they are frequently influenced by market sentiment, social media trends, or speculative behavior. This can lead to investments that are far removed from traditional value-driven strategies. As such, investors in these markets tend to experience high levels of stress and anxiety, trying to predict the next move and constantly reacting to market fluctuations. For individuals who don't have the time, experience, or resources to monitor these investments daily, short-term strategies are particularly risky. These kinds of investments require constant attention and quick decision-making, which is often a disadvantage for those with full-time jobs or other responsibilities. This creates an environment where the goal isn't necessarily wealth accumulation, but rather trying to stay afloat in an unpredictable market. Additionally, short-term investing can disrupt the ability to create long-term wealth. Instead of setting aside money for future growth, the focus is on trying to get rich quick, which ultimately leads to a lack of strategic planning. It's easy to fall into the trap of making impulsive decisions based on the desire for quick rewards. But the true path to financial success lies in planning, patience, and strategic long-term investments. If the world of short-term investments feels like a gamble, long-term investments offer a strategic, steady, and secure path toward building wealth. While they may not promise quick riches, the true power of long-term investments lies in their ability to grow gradually, providing consistent returns over time. This is where patience becomes your greatest asset. Whether you're investing in stocks, real estate, or mutual funds, the key to success is understanding how these investments compound over time. Long-term investments, such as stocks of well-established companies, real estate properties, and diversified funds, have a proven track record of delivering reliable returns. Unlike speculative assets, these types of investments are driven by the fundamental growth of businesses, the real estate market, and the economy as a whole. With long-term investments, you are more likely to benefit from the steady appreciation of assets, reinvestment of dividends, and compounding interest, which gradually increase the value of your portfolio. Consider the example of Warren Buffett, one of the most successful investors of all time. Buffett's investment philosophy is rooted in the belief that time is a critical factor in wealth accumulation. Rather than seeking short-term gains, Buffett focuses on buying businesses with strong fundamentals that will grow over time. His investments in companies like Coca-Cola and American Express are prime examples of how holding quality stocks for decades can yield extraordinary returns. Over the years, these investments have compounded and provided consistent returns, resulting in a fortune built not on speculation, but on solid long-term strategies. The concept of compound growth is central to long-term investing. In simple terms, compounding allows your investments to generate earnings not just on your initial capital, but also on the interest or returns that have already been accumulated. This snowball effect grows exponentially over time, turning small investments into substantial wealth. For example, turn your modest monthly investment in a mutual fund that grows at an average rate of 7% annually could potentially double in value every 10 years. The longer you allow your money to compound, the greater the wealth you can accumulate, often surpassing the results of short-term speculative trading. Another benefit of long-term investing is risk reduction. While short-term investments are susceptible to sharp market swings, long-term investments tend to smooth out these fluctuations. In the stock market, for instance, short-term volatility can cause significant price swings, but over the long run, the market has historically trended upward. Holding investments for years, sometimes decades, allows you to ride out market downturns and benefit from periods of growth. The key to mitigating risk is diversification, spreading your investments across different asset classes and industries, so you aren't overly exposed to any single market event. Real estate is another classic example of a long-term investment that has consistently outperformed short-term alternatives. While the real estate market can experience fluctuations, historically, property values have risen over time. By investing in real estate, you are tapping into a tangible asset that provides both capital appreciation and potential rental income. Over the course of several years, a property's value may increase significantly, and its rental income can provide a reliable income stream. In summary, the true power of long-term investments lies in their ability to provide gradual and consistent growth. By focusing on quality assets that appreciate over time, reinvesting your earnings, and taking advantage of compounding interest, you can steadily build wealth without the uncertainty and risks associated with short-term speculation. Long-term investing is a strategy that requires patience, but the rewards are undeniable. Now that we've explored the importance of long-term investments and how time works to your advantage, it's time to compare short-term and long-term investment strategies head-to-head. By examining the pros and cons of both, you'll be better equipped to make informed decisions based on your financial goals and risk tolerance. Short-term investments. The risks and rewards. Short-term investments are characterized by the desire for quick returns. These investments generally involve higher volatility and uncertainty as they are influenced by short-term market movements, trends, or speculations. Think of options trading, cryptocurrencies, or even the frequent buying and selling of stocks based on market sentiment. While these investments can indeed offer substantial rewards, they are also incredibly risky. The major advantage of short-term investing is the potential for fast profits. In a favorable market, it's possible to see rapid returns on a small initial investment. For instance, some cryptocurrencies or stocks have experienced meteoric rises in price over a short period of time. The idea of making money quickly is undeniably appealing, but the volatility of these markets makes it a high-stakes game. Prices can swing drastically, and without careful attention, you may find yourself losing just as quickly as you gained. Moreover, short-term investing often requires constant monitoring of the market. The need to track stock prices, crypto valuations, or even market trends means that investors are often glued to their screens, making split-second decisions. This constant vigilance can create unnecessary stress, especially for those who don't have the time or expertise to follow every market shift. In short, while short-term investments may appeal to some for their immediate rewards, they come with substantial risks and require a level of expertise and attention that may not be feasible for every investor. Long-term investments, the stability and growth of a slow-burn strategy. In contrast, long-term investments focus on gradual, consistent growth over time. The hallmark of long-term investing is the commitment to holding assets for years or even decades, allowing them to appreciate naturally through market cycles. Unlike short-term investments, which are often driven by speculation, long-term assets are more likely to reflect the true value of the company or asset you're investing in. For example, investing in established companies like Apple or real estate in growing markets tends to offer more reliable returns over the long haul. One of the key advantages of long-term investing is its ability to weather market volatility. While short-term investors may panic during a market downturn, long-term investors tend to stay the course, knowing that fluctuations are part of the normal market cycle. Historically, markets tend to recover over time, and long-term investments benefit from this steady recovery. Whether you're invested in stocks, bonds, or real estate, holding onto these assets allows you to ride out market declines and still benefit from the growth in the years to come. Furthermore, long-term investments tend to be less stressful. Once you've selected your investments and set a strategy, you don't need to constantly monitor your portfolio. You can confidently let your assets grow while focusing on other priorities. The compounded returns on long-term investments make them a more relaxed and sustainable way to build wealth. With the power of compounding, you can rest assured that your investments will continue to grow over time, without needing to check your portfolio constantly. The disadvantages of long-term investing are few, but they exist. The most obvious is the delay in seeing returns. Unlike short-term trades, where you might see profits or losses within days or weeks, long-term investments require patience. For some, this delayed gratification can be frustrating, especially when they feel they could be earning more in the short term. However, the long-term rewards typically outweigh the temporary impatience. Which is right for you? The key to choosing between short-term and long-term investments lies in your personal financial goals, risk tolerance, and the amount of time you can dedicate to managing your investments. If you're looking for quick returns and can handle high risk, short-term investments may suit your style. However, if you want to build lasting wealth and enjoy consistent growth over time, long-term investments are the way to go. Now that we've discussed the differences between short-term and long-term investments, let's turn our attention to how you can actually start building a long-term investment portfolio. The key to success in this area lies in starting early, being consistent, and diversifying your assets to spread risk and increase potential for growth. Here's a step-by-step guide on how to begin your journey. Step 1. Define your investment goals. The first step in building a long-term portfolio is to clearly define your financial goals. Are you saving for retirement, a major purchase, or simply trying to build wealth over time? Your goals will help guide your investment decisions and determine your risk tolerance. For example, if you're investing for retirement in 20 to 30 years, you may be able to tolerate more risk, such as investing in stocks or real estate. If you're saving for a down payment on a house in the next 5 years, you might opt for less risky investments, like bonds or certificates of deposit, CDs. Step 2. Evaluate your risk tolerance. Understanding. Your risk tolerance is critical to ensuring you don't overextend yourself. Risk tolerance refers to how much risk you're willing to take on in pursuit of higher returns. Typically, younger investors can afford to take on more risk as they have more time to recover from any losses. On the other hand, someone closer to retirement may choose to take fewer risks and focus on more stable, income-producing investments. There are various risk assessment tools online that can help you evaluate your risk tolerance, so take advantage of these resources before you begin investing. Step 3. Diversify your investments. Once you have a clear understanding of your goals and risk tolerance, it's time to diversify your portfolio. Diversification means spreading your investments across different asset classes, such as stocks, bonds, real estate, and perhaps even alternative investments like commodities or cryptocurrencies. The goal of diversification is to reduce risk by ensuring that your entire portfolio is not dependent on the performance of a single asset. This strategy also helps you take advantage of different opportunities for growth in various markets. For example, consider investing in a mix of large-cap stocks for stability, small-cap stocks for higher growth potential, and real estate for a more tangible income-producing asset. Additionally, adding bonds to your portfolio can provide steady income while offering lower risk. Diversification can also include international investments, which help hedge against domestic economic fluctuations. Step 4. Choose the right investment vehicles. There are several types of investment vehicles to choose from depending on your goals and preferences. Exchange-traded funds, ETFs, and mutual funds are popular choices for long-term investors as they offer instant diversification and are generally low cost. If you're more hands-on, you can also invest in individual stocks or real estate properties. The key is to choose a mix of investments that align with your financial goals, risk tolerance, and investment horizon. Step 5. Be consistent and patient. One of the most important aspects of building a successful long-term investment portfolio is consistency. Even if you're only able to invest a small amount each month, doing so consistently over time will have a compounding effect. Avoid the temptation to time the market or make drastic changes based on short-term market movements. Instead, focus on your long-term strategy and let your investments grow at their own pace. Building a long-term investment portfolio requires more than just knowledge and strategy. It also requires a mindset shift. The way you think about money, growth, and patience directly influences your ability to succeed with long-term investing. This shift from a get-rich-quick mentality to a more patient, disciplined approach is crucial for ensuring that your investments yield positive results over time. The importance of patience and discipline. One of the most significant challenges in long-term investing is the need for patience. Unlike short-term investments, which offer the potential for quick wins and losses, long-term investing requires a focus on gradual growth. Early on, you might not see the returns you were hoping for, and this can be frustrating. However, it's important to remember that wealth building is a marathon, not a sprint. The key to long-term success is staying the course, even during periods of market volatility. For example, during market downturns, investors often panic and make hasty decisions, such as selling off assets to minimize losses. This behavior undermines the potential for long-term gains, as it locks in those losses instead of allowing the market to recover. A long-term investor, however, understands that volatility is a natural part of the market cycle and chooses to stay invested, trusting that their assets will appreciate over time. This mindset requires discipline, sticking to your investment plan even when it's tempting to jump into the latest market trend. By consistently investing, regardless of short-term market conditions, you give your portfolio the time it needs to grow and compound. Avoiding emotional decisions. Investing, especially over the long term, is as much about controlling your emotions as it is about making smart financial choices. Fear and greed are two of the biggest emotions that can lead to poor investment decisions. For example, fear of losing money might prompt you to pull out of investments during a downturn, missing out on future recovery. On the other hand, greed can lead to chasing hot trends or speculative investments, disregarding the long-term stability of your portfolio. Successful long-term investors learn to recognize these emotions and manage them. They set clear investment goals and avoid making decisions based on temporary market movements. One useful technique is to automate your investments. By setting up automatic contributions to your investment accounts, you take the emotion out of the process and ensure consistency in your investment strategy. Focusing on long-term goals. To stay motivated during the ups and downs of the market, it's essential to keep your long-term goals in mind. Whether your goal is to retire comfortably, fund a child's education, or build wealth for future generations, having a clear vision of your objectives will help you remain focused. It's easy to get distracted by short-term market fluctuations, but reminding yourself why you're investing can help you stay committed to your long-term strategy. Embracing the power of compounding. One of the most powerful aspects of long-term investing is the power of compounding. The earlier you start investing, and the longer you let your investments grow, the greater the potential for your wealth to multiply. Compounding allows your returns to generate more returns, leading to exponential growth over time. This is why starting early and staying consistent is so important. It gives your money more time to work for you. In conclusion, adopting the mindset of a long-term investor requires patience, discipline, and emotional control. By focusing on steady growth, avoiding impulsive decisions, and reminding yourself of your long-term goals, you can build wealth that lasts. Remember, successful investing is not about getting rich quickly. It's about making smart, informed decisions and letting time work its magic.